this week could be the make or break for the market. We got four central banks making interest rate decisions. We have a high stake meetings between Trump and China for a deal. We have a lot of earnings, but particularly those for Meta, Microsoft, Google, and Amazon and Apple. So 5 of the Max 7s within a 48 hours window. And that's at the same time as those central banks. We'll talk about how gold and Bitcoin could really have big moves depending on how everything I mentioned before is going to go this week. And what does it mean for your money? So first, we'll go quickly into the context you need to understand to better see what's coming. Then I'll break down some of the red flags with charts and other things. And then we'll cover how to invest smart based on this data. So very briefly, there's been more issues in the banking sector in the past week or two. More bankruptcies, more people discovering shading things, like, for example, bankruptcy linked to fake invoices that were used as collateral to get a loan. So that's the kind of stuff you see close to a market top when people were not paying attention, like in 2001 in tech or in 2008 with the real estate. So those are warning signs. Another major sign that the economy is not doing as well as you can hear on the mainstream media is the layoffs, but particularly in the AI sector. We hear about layoffs like in Target, general store. But when AI companies keep telling you that there's unlimited demand for the services, that they cannot scale fast enough, they shrink their team. And today, there was, even before I recorded this video, a new one from Amazon. They announced the biggest layoff in the company history. Many people think Amazon, like, you order stuff online, but it's way more than that, way more than this. And they also have an AI team as well. So, doing some massive layoff like this before the busiest season of the year, and while AI is supposed to be like so hot that they cannot get enough people to work on it, the cracks are really starting to show. For the rest of the businesses also that are not in AI, I mean, they've been feeling it for the past 2-3 years, and there are more and more articles like this showing how bad it's getting. So let's look at some charts. I'll show you some major divergences because this is a major red flag when you see a divergence between the price action and another indicator going in the opposite direction. We'll look at some scary similarities. These are good to see because it doesn't mean the price action will be exactly what you saw in the past. It's just that price action has a lot to do with fear and greed. And so that's how people behave, and this has not changed. And so that's why you see those moves that look similar in different periods of time across different assets. And also we'll look at who's driving the market. As I mentioned in the previous video, at tops, usually you see institutional big players, hedge fund dump everything they have on retail investors like you and me. So just something to keep, to be aware of it, so you are not buying at the top and then regretting it. So let's look at the first chart, and you may have heard of the Dow theory. Basically, it says that when the Dow Jones is going in one direction, but the Dow Transport is going in the opposite direction, that's not a good sign, because the real indicator of a booming economy is how many trucks you have on the road to deliver things you order online or you buy in store. And for the past 6 months, they've been diverging, but in the past 2-3 months, it's been even bigger divergence. Like it keeps growing. And when you look back at what happened in 2008 before the financial crisis, for about 5 months, you had a divergence, and then there was the big crash. So just something to keep in mind. Here's just a bigger chart for just this year to show you how big the divergence since the April low has been and how wide it's got. I think it's the widest it's ever been. So something to pay attention to. Here it's NASDAQ, another type of divergence. So in the middle, you have the price of the NASDAQ. And at the top, you can see that while the price is going up, the number of companies participating in that price action is actually declining. So you have less and less companies participating, and they're below their long-term trend lines. So this is the 50-day trend line, and this is the 100-day trend line, but in both cases, it's going down. So it's only a few companies propping up the whole NASDAQ and the whole S&P 500. And so that's why those earnings, when I talked about it earlier, they're going to be major, because if they don't give something more than the market expects, they will tank, and so will the market. Another one that's worth mentioning briefly, let me know if you want me to go into more detail, but basically private credit has been usually very correlated to the index. And since the April low, it actually hasn't been that much. We can see that up until June, July, it was kind of going there. in the same direction, but then since July, they've been tanking like crazy. And so it seems like, they know something that we don't. And the people investing in private credit are already starting to cash out because they see that the real economy is nowhere near as good as what, central banks and mainstream India and government have been saying, basically. Another similarity that's kind of, not reassuring is when you look at the SP 500, it's been bouncing from the week it spent within that red candle. And so we had actually 2 days of up, but they have been gapped. And this is the kind of price action we saw actually at the end of February 2020. Remember what happened after in March, the big crash, the big COVID crash. So something to keep in mind. It's a lot of signs that the market is fragile, and so it could roll over anytime. At the same time, if there are a lot of good news, it could just go for one last blow of top. So you never know how it's gonna be, but it's just once you're aware of the signs and the similarities and divergences, you can make a more informed decision. So that's the way I see it. When I was talking about who's driving the market, right now, and actually since April, it's been mostly retail. So you and me, people, everyday investors, piling onto every big companies, especially every time there's a dip, but they're borrowing money for it, either through just regular borrowing in the margin account, or they are buying options. So here you can see the chart of option volume for retail investors, and it's going like parabolic, like off the charts. So that's usually not a good sign. Another worrying sign is here's the black line is the CTA allocation. So basically, it's the automated computer algorithm that buy and sell. And right now, they are basically at full allocation. So, if the market, even if the market goes up, they can't really buy more. But if the market goes down, they can actually trigger big sell. And as you can see, if it's one standard deviation, they could wipe out like $50 billion out of the 70 they have right now. And if it's two standard deviation, they could wipe out basically almost everything they invested in 2025 so far. So this could be really an accelerant for a crash if there was a crash coming. Another quick chart to show you that despite all the euphoria, especially when you look at the chart, which I will show you in a sec, of the S&P and the Nasdaq, it looks fine. It's at all-time highs, so why worry? Well, if you look, last week was actually the worst week for selling since the April lows during the tariff announcements. So you can see how behind the scenes, it's not what the chart looks like when you look at the chart without the data to understand what's really going on. This is what I was talking about, like S&P and Nasdaq, both all-time high, both 2 days of growth with gaps, which by the way, usually are filled. So this looks like a potential fake out. It's when the price goes quickly up before crashing down, just to get those last people who are on the sidelines to get in because of FOMO. So this is a worrying sign. It could still go up for a few weeks or a few months if there's some really good news this week. Like, you never know. But right now, this feels like something that's fragile. Also, when I look at the volume, those increases were not done on big volume. They were actually at or below the average volume. So that's not usually a good sign when you have a big move that's not followed with volume. As you can see, when they crashed, the volume was massive. It was like more than twice the average volume. So that was a real move. Those 2 days, not really, and same here. So just something to keep in mind. Gold and silver, you can see they have similar charts. As I mentioned a week ago, they were due for the pullback. I mentioned that they could go down to 3,500 for gold and 45 for silver. This is like not the worst case scenario, but it's more like if there was a big pullback, it could actually stop around the level where it is at right now. So it could just consolidate for a few days or a few weeks, depending on how things go. But I can definitely see them going up between now and the end of the year, because I feel like most people are not yet allocated to gold and silver. And so once more and more people ask their broker or buy it themselves, there was just more demand than supply, in my opinion. I have a few more charts quickly to show you for gold. So this is just to show you how since about 2024 here, basically the assets under management for gold in the ETFs have doubled from 125 billion to over 250 billion. So that's huge, and that's just with a few people getting to gold. Most people still are not allocated to gold. So that's kind of insane when you think about it. But eventually, I think most people are going to realize that with the debasement going on, gold is one of the things that they will want in their portfolio. And I see more and more people replacing a portion of the bonds with gold. So this is likely just going to keep growing, which is why I think gold eventually will continue to go up, but has to take a break at some point. Just to show you how insane it's been in the past few weeks, usually gold is about 1 to 2% of global volume, but in the past few weeks, it went as high as 8% of the total volume in the of the ETFs was gold. So that's kind of insane. And this is also parabolic for the options volume on GLD, which is the main ETF for gold. So really, everybody's been piling onto gold. Everybody who knew about gold has been piling onto gold, but there's still more room, in my opinion. And here quickly on Bitcoin. So it went back up above the critical level. That's the average price of short-term holders. So people who bought in recently, they are no longer in at loss, so they have less pressure to sell. We are kind of at a neutral zone right now, so that's why I put those two arrows. Like there's not yet a clear direction for it. So it could go up, it could go down. We have to wait basically for a decisive move above the previous all-time high or below the major support. That was kind of before or during the recent crash. So something we have to keep watching. But yeah, at the same time as everything else is going on, Bitcoin and gold are kind of waiting to see how the week will unfold. And based on this, it could really go up or go down. So it's kind of something to watch. So now let's quickly get onto the main events this week. So basically, within 48 hours, so Wednesday and Thursday, we will have the 4 central banks, saying their decision for interest rates. So it will start with the Bank of Canada, which will likely cut 25 basis points. At least that's the market expectation. In my opinion, it's almost a guarantee. Potentially, they could cut by 50 if they really want to help the economy that's been, deteriorating quickly. The Fed is also likely to cut at least by 25 basis points. That's also the market expectations. And if they have access to more data than we know, maybe they could cut more, just because it takes time for the rate cuts to be felt into the economy. So if they see that it's actually getting worse, they could say instead of doing 25 now and 25 in December, maybe they will do 50 now. We'll see. Overnight, there will be the Bank of Japan. Right now, there's no expectation for cuts or hikes, but with the new prime minister, you never know if something could change and could shock the markets. And the next day, you have the ECB, the European Central Bank, which is not expected to cut, but could cut if they want to stimulate the economy, because the economy in Europe continues to deteriorate, particularly in France and Germany, which are the two main countries that are or were powering Europe, and right now they are a bit in trouble. So potentially they could be cutting to try to stimulate the economy there. And at the same time as we'll have those 4 decisions from the central banks, we will have the earnings for 5 of the 7 most important companies right now, companies holding up the stock market together, basically. So we'll have Microsoft, Meta, which is Facebook, and Alphabet, which is Google, all 3 after the close of market on Wednesday. And then on Thursday, after the close of market, we'll get Apple and Amazon. So depending on how they do, both with the earnings versus expectations, but also with the forward guidance they will give during the earnings call, this could really move market big time. And so, when you take all of this together, it's going to be a lot of volatility probably, because it's unlikely that everything will go in the same direction. So, investors will likely be torn between do invest more, do invest less, depending on everything they have to assess in a very short amount of time. And we never know, the shutdown could end anytime, and then there would be a lot of data coming into the market as well. So it's going to be a lot of data to digest for the market, and that's why it's going to be both interesting and scary at the same time. So what can you do with all of this? Well, basically, now that you have this information, you could, kind of look at your portfolio, and if you're allocated in a way that, it stress you out, maybe it's a good time to kind of reduce your exposure to risky stock. It doesn't mean sell everything. It just means, trim it down maybe if you think you would sleep better at night. On the other side, some people are all in cash right now because they're waiting for a crash. And that's how you can get into FOMO and buy at the top, because you wait, you see everybody making money. And then right at the end, at the top, you're like, okay, I'm done. I'm buying back in the market. Usually that's the top. So it's a good occasion for people on both sides to kind of reassess and potentially to have an allocation that makes more sense with all the data that you have now right now. If you want to find a way to invest that kind of lets you stay in the market, but cap your risk, limit your risk and decide what your risk is. And I'm not talking about the stop loss. I'm talking about something that's actually guaranteed. You can look at my free masterclass. It's 5 strategies that can help you to minimize risk and maximize gains. It's done with options, but it's way easier than you think if you never used option. So I'll put the link in the description and at the end of the video in case you're interested. If you have any questions, let me know in the comment. I'll be happy to answer your questions. I'll do my best to help you out. So thank you, and until next time.